Hey guys, it's Aman
and Christina
from Our Rich Journey. It is July 2019 and it is time for our stock portfolio update. If you've been following our channel, you know that we invested $10,000 in December of 2018, and for the past 8 months we have been dollar cost averaging $833 into the market. Our goal is to invest another $10,000 over the entire year. Well, today we are going back into our portfolio and we are sharing with you our holdings.
Each month we go through our stocks and we show you how our stocks are performing. We do this so we can show you how everyday investors invest in the stock market. We also answer questions, but in this video we're not going to answer questions. We are going to do a total recap of all the stocks that we've been investing in. We're going to talk about our feelings about each stock and how each stock has performed. Let's start with an overview of the entire portfolio before we go to each stock. In December 10, 2018, we invested $10,088 in 10 different stocks: AT&T, IBM, AbbVie, General Motors, Ford, Iron Mountain, Medical Properties Trust, AGNC, Prospect Capital, and Main Street Capital.
We divided the $10,000 evenly across all stocks, investing about $1,000 in each stock. And every month between the 10th and the 15th of every month, we've invested another $833 in the stock market, for a total of $15,919 of our own money. So let's just pause on that for one moment, because this is a very important point about investing. Is it about being consistent? And for the past 8 months, we have religiously invested $833 into the market, never missing a month. And that's how you are successful at investing, by being consistent in what you do.
And we don't just pay ourselves first in this investment portfolio account. We pay ourselves first in our emergency savings account, in our 401k, in our Roth IRAs, in our health savings account, in our brokerage account, and in our kids' custodial accounts. This is a key to building wealth, prioritizing your investments.
Okay, so back to the Robinhood portfolio.
We have invested $15,919. The current portfolio value is around $17,287, meaning our portfolio is up $1,368. The growth of our portfolio has come from appreciation of our stock, but also from dividends.
Our portfolio is all about the dividend income. If you recall, when we first started this portfolio, our goal was to invest in high dividend stocks. That is because we want to use this portfolio to supplement our other income in early retirement. The dividend income that we collect every month from this portfolio is the most important thing. So we're not focused necessarily on the growth of the stocks, but more so on the consistency that the stocks pay in dividends. And we've talked about having a strategy for your portfolios in other videos. For us, it's dividend income with this portfolio, but you may be focused more on stocks that are growth stocks or speculative stocks, or you want to play stocks that are more defensive. But for us, it's focused on the income.
So let's talk about our dividend payments. In the last 8 months, we've collected 38 dividend payments. In January, we collected $25.76. In February, $58.40. In March, $87.19. In April, $83.57. In May, $53.51. In June, $102.22. And in July, $103.02, for a total of $513.67. So the $1,368.48 of growth from our portfolio, $513.67 of it is made of dividends and the rest from stock appreciation.
Woo! $513. That is having your money work for you. That is the purpose of this portfolio, to get that type of income every single month. At this point, it's only around $100 a month, but eventually that money will grow and we will be getting more income every month. But let's talk about the stocks now.
We usually talk about the transaction of each stock, but in this video, we are going to be talking specifically about the companies that we're investing in, our thoughts about the companies, and our views going forward in terms of investing in those companies. The first stock is AT&T. We purchased AT&T in December for $29.57 a share and have been adding to it every month. The current price is $33.53 a share. We purchased 3 more shares this month. We now own 55 shares valued at $1,844.15. When we purchased AT&T, we thought the company was undervalued. It was a great deal. The company has been growing to be much more than a wireless company, but also an entertainment company with its acquisition of Warner Media. Our purchase of AT&T has paid off. Our shares are up almost 11%. AT&T pays a quarterly dividend of 6.1%. Since owning AT&T, we've collected $40.80 in dividends. AT&T earnings have been mostly good, meeting expectations every quarter we've owned the stock. And the outlook is positive for AT&T. We think the company will continue to grow profits, and most importantly, the dividends. One thing about AT&T is that it pays its dividends. The company has increased its dividends for 35 consecutive years, and this strong dividend will also attract buyers when the market starts to dip. So we're sticking with AT&T.
The next stock is IBM. We purchased IBM in December for $120.50 per share and have been adding to it every month. The current price is $141.89 per share. We purchased 1 more share this month, and so we now own 14 shares valued at $1,986.46. When we purchased IBM in December, we felt like it was a huge deal at only $120 a share. Our purchase has paid off. Our shares are up over 12%. IBM still looks cheap at just 10 times its forward earnings, and it pays a high forward dividend of 4.6%. IBM pays a quarterly dividend. Since owning IBM, we've collected $33.57 in dividends. IBM has been having a great year. In the last 2 earnings reports, it has reported better than expectations, and Wall Street has been very optimistic about the stock. IBM leadership has also been more focused on growth, so the company has been focused on blockchain technology, the cloud, analytics, security, mobile, and social businesses. For example, IBM just finished buying Red Hat, another technology company that will help grow their business. IBM is an old established company with a solid dividend, so we are sticking with IBM.
The next stock is AbbVie. Some of you may not be familiar with AbbVie, but it's a biotech company. In 2018, it had a clinical trial for a cancer drug that failed and Wall Street beat it up. The company also has a lot of debt. All this resulted in the stock losing around a quarter of its value, which is when we decided to purchase it because we thought it had fallen too much. Before the clinical trial failure, the stock was considered one of the top dividend growth stocks in all of healthcare. We purchased AbbVie in December for $86.14 a share and have been adding to it every month. The current price is $69.21 a share. We purchased 1 more share this month. We now own 21 shares valued at $1,453.41. Our shares are down 16.4%. AbbVie still looks good to us over the long term. We think it's a beaten up bargain dividend stock trading at less than 8.4 times expected earnings, which is very cheap considering that it's lower than the forward earnings multiples of more than 400 other stocks in the S&P 500. So every purchase we make now, we see it as a bargain purchase. AbbVie stock has an amazing dividend of 5.6%. That's not only the highest yield in healthcare, but it's also one of the highest dividend yields in the S&P 500. AbbVie has a solid track record when it comes to dividends. The company is included in the elite group of stocks known as Dividend Aristocrats. AbbVie has increased its dividend for 47 consecutive years, and AbbVie pays a quarterly dividend. Since owning AbbVie, we collected $31.03 in dividends. Moving forward, we think AbbVie will do better. It has new drugs being developed that are expected to be huge. Its last earnings call beat expectations by a lot, so things are looking good. With a solid dividend and cheap valuation of the stock, we are sticking with AbbVie.
The next stock is GM. We purchased GM in December for $33.94 and have been adding to it every month. The current price is $39.34 per share. We purchased 3 more shares this month. We now own 46 shares valued at $1,809.64. When we purchased GM in December, we felt like it was a great deal since it was trading at a discounted price, at just 5 times its forward earnings. This is very cheap. Well, our purchase has paid off. Our shares are up 11.63%. GM pays a quarterly dividend of 4.3%. Since owning GM, we've collected $28.12 in dividends. GM's earnings have been outstanding, beating Wall Street expectations every quarter we've owned it. GM's outlook is very positive. The company is very profitable. We also think the stock will go higher with the launch of its highly anticipated autonomous ride-sharing service in San Francisco later this year. And an easing of trade tensions could also move the stock higher. So we are sticking with GM.
The next stock is Ford. We realize that Ford and GM are both car companies, and having them both in this portfolio isn't the best for diversification, but we felt that Ford was too good of a deal to pass on. The stock was so low and the dividend was so high that we thought this was a great value. So we purchased Ford in December for $8.61 a share and have been adding to it every month. The current price is $10.41 a share. We purchased 9 shares this month, and we now own 186 shares valued at $1,936.26. Our purchase of a second car company stock has also paid off. Our shares are up over 18%. Ford pays a quarterly dividend of 15 cents per share, a rate that it has maintained since the beginning of 2016. That translates to a dividend yield of 5.9%. Ford pays special dividends throughout the year, which are nice. Since owning Ford, we've collected $45.75 in dividends. Ford's earnings have been okay, not bad, but not outstanding either. But the outlook is positive for Ford. In our opinion, they're improving processes and cutting costs. New models will have people buying their new vehicles. The company is also doing a good job of keeping up with the electric car movement while maintaining its core vehicles like the F-150. The trade wars have seemed to help this stock, but it will move it up and down in the short term. But over the long haul, we think it's going up and the dividend is going to remain strong, so we're sticking with Ford. The next stock is Iron Mountain. If you're not familiar with Iron Mountain, it's a REIT that specializes in a document storage. And because it's a REIT, 90% or more of its income has to be paid out as dividends. So the dividend on this stock is high. We purchased Iron Mountain in December for $33.97 a share and have been adding to it every month. The current price is $30.03 per share. We purchased 3 more shares this month. We now own 52 shares valued at $1,561.56. Our shares are down 10.3%. But we're fine with that because Iron Mountain is a solid company, and every purchase we make now, we consider it a deal. We're getting to buy a good company that pays a great dividend. Iron Mountain pays a huge dividend of 7.8%. Since owning Iron Mountain, we've collected $70.88 in dividends. This is one of our larger payments in the dividends from a single company. Even though Iron Mountain hasn't had the best quarterly earnings, we expect things to improve. For example, the business is expanding its data storage services. It's also focusing on emerging markets and data center businesses. Lastly, Iron Mountain is improving its processes to reduce expenses and increase profits. In the long term, we think the dividend is strong and the stock will rebound, so we're sticking with Iron Mountain. The next stock is Medical Properties. You've heard us talk about this REIT in our REIT video. It's a healthcare-focused REIT that's been hitting all-time highs. We purchased Medical Properties in December for $16.94 a share, and we've been adding to it every month. The current price is $18.44 a share. We purchased 5 more shares this month, and we now own 93 shares valued at $1,714.92. Our shares are up 6.47%. The company is doing very good, beating estimates every quarter we've earned it. With REITs, it's important to have strong financials, and MPW is in a great financial shape. It has low debt and income is growing. The company is expanding and recently purchased 11 Australian hospitals. We like Medical Properties and will be sticking with it.
Next is AGNC, a mortgage REIT. Most people don't know how mortgage REITs work, but the business model is simple. Agency borrows money at a low short-term rate, then purchases mortgage-backed securities and other assets that yield a higher rate over the long term, then pocket the difference as their net interest margin. We purchased Agency in December for $17.77 a share and have been adding to it every month. The current price is $17.22 a share. We purchased 4 more shares this month, and we now own 93 shares valued at $1,601.46. Our shares are down 2.7%. We invested in Agency for 2 reasons. Agency has a relatively safe business model since it invests nearly all its assets in loans protected against default by Fannie Mae and Freddie Mac. Agency pays a monthly dividend. Its current dividend yield is 11.21%. Since owning Agency, we've collected dividends every month for a total of $86.54. For us, the monthly dividend income will be awesome when we retire early. The company is doing fair. The company didn't have a very good earnings call last quarter and blamed the poor performance on interest rate hikes. The company also lowered its dividend, but only slightly, and not enough for us to sell AGNC. For the time being, we are sticking with Agency, but we'll be watching to make sure it doesn't lower its dividend again.
Next is Prospect Capital. It's a business development company, and it's definitely one of our riskier investments in the portfolio. If you're not familiar with a business development company, here's a quick definition. It's an organization that invests in small and medium-sized companies as well as distressed companies. A business development company helps the small and mid-sized firms grow in the initial stages of their development. With distressed businesses, the business development company helps the companies regain sound financial footing. Prospect Capital is another company that pays a monthly dividend. We purchased Prospect Capital in December for $6.74 a share and have been adding to it every month. The current price is $6.71 a share. We purchased 13 more shares this month, and we now own 245 shares valued at $1,646.40. Our shares are up 0.75%. PSC pays a monthly dividend. Its current dividend is 10.76%. Since owning Prospect Capital, we've collected dividends every month for a total of $66.48. Again, we like the monthly dividend income. PSC is one of our riskier investments. However, the company is doing well. Over the last 4 quarters, the company has surpassed consensus earnings per share estimates 3 times. However, since this is a financial company that makes its money from loaning money to other companies, if the economy starts to slow, then it will issue less loans and make less money. This could cause Prospect Capital to cut its high dividend. We are sticking with PSC and will be watching it to make sure it doesn't lower its dividend. The last stock is Main Street Capital. This has been a great investment. Main is another business development company. The company provides financing in both debt and equity to small and mid-sized businesses early in their development. The company makes its profits when the companies it invests in do well. Main is a risky investment because if the companies do poorly that they invest in, Main assumes some of that risk. We purchased Main in December for $37.60 a share and have been adding to it every month. The current price is $42.05 a share. We purchased 2 more shares this month and we now own 41 shares valued at $1,724.05. Our shares are up 10.8%. Main pays a monthly dividend. Its dividend payment is currently 5.88%. Since owning Main, we've collected dividends every month for a total of $48.35. Again, we like the monthly dividend income. Like Prospect Capital, Main has the same risks, which is if the economy starts to slow down, then it will issue less loans and also make less money, and this could cause Main to cut its high dividend. We're sticking with Main and we'll be watching to make sure it doesn't lower its dividend.
And that's our stock portfolio update for July 2019. We are so excited with the direction the portfolio is going because our income has been growing every single month. This is the purpose of this high dividend portfolio, to see our income grow high enough that it supports our other needs in early retirement. If you guys like this series, please leave us a question that we can answer in an upcoming video. And as usual, give this video a thumbs up, subscribe to our channel, and join the journey.